how you use them.
T-minus 3, 2, 1, 0, and liftoff.
Hello, hello, hello. Welcome back to the Biz Doc podcast. We're here, and today everybody keeps asking me about these shirts. These are authentic Formula One shirts from the teams themselves. Some of them, I knew someone on a team. Some of them, a team member, sold it to me, but these are authentics. I got the old Jaguar F1 here. Mark Webber was a driver way back in the day. Real exciting. By the way, they once did this thing in Monaco where they put like this 5-carat diamond on the nose of the car that was racing at Monaco. And would you know it, that particular car hit the side of the track a little bit, tore off the nose, and they never found the diamond. Either that or one of those track rescue workers had an incredibly nice gift for his wife when he got home from work from being a track worker. Anyway, today I am here with Kellyanne, the Swiss Army knife, showing charts, putting things together, and bringing her own perspectives as we're here to talk about things. We have a pretty cool lineup today. There's some big things going on this week that are not just going to be big this week. You can go back and look at this anytime. But we are just sitting here. What better way to enjoy a vault? Watermelon's my favorite color.
Mine too.
Yep, also my favorite flavor. I just said color.
Yeah, I knew what you meant. I meant the same thing.
But what we got some stats, and then we got a case study on IPOs. And IPOs that are happening this week, you have ARM that went out right at the end of last week, and you've got Instacart getting priced tonight, going out tomorrow, and I'm going to talk all about that during the case study. And by the way, if you're looking at this a year from now, this is just a history lesson of how we got IPOs going again after we had just sort of a dearth in a desert where there weren't IPOs happening in 2021, 2022 as we came out of COVID and interest rates went up and bada. It still is applicable to you, your business, whether you're looking to invest in IPOs or you envision your company going out for an IPO, all applicable to you, and that's what I'm trying to deliver. Value you can use today and tomorrow. We also have stats today, very interesting stuff. New business applications from the Department of Commerce, got some stats on that. Also, union strikes are up, but union membership is way down. We're going to talk a little bit about that. And then Meta, specifically the Facebook division of Meta. We're going to talk about what they need in terms of markets and why. Some markets you need, some markets you don't. You could have a global footprint, but most of your revenue maybe be in 2 countries, like in India and United States or something, if you're in IT. I'm going to walk through it. There's some surprising things about the value of the United States to Facebook. So let's roll right into it. Businesses today are facing a rough world. The stock market is angry. Federal legislation is sending taxes down, threatening to wipe out value. It's just a very, very tough time. As an investor, where do you turn and what do you do? I think precious metals is a great alternative. Businesses today are facing a rough world. The stock market is in an angry mood, as is the economy. Banks are failing. Inflation is never ending. And a looming recession threatens to wipe out stock value. That's bad for business, but even worse for retirement funds, especially if you're the one getting ready to retire. And to make things worse, the government is targeting those retirement funds, your 401ks and your IRAs, with heavy new taxes to pay for things like social justice agendas and federal deficits. The good news is that there is a way to help protect your financial future, investing in precious metals. American Hartford Gold will ship physical gold and silver directly to your door. Or they can set you up with a gold IRA where you can invest in gold that shows up in your IRA. The gold IRA can shield your wealth from this economic meltdown, and the best part is this method is tax and penalty free. That's right. Analysts predict that gold is set to hit all-time highs. If you have retirement funds that you cannot afford to lose, now is the time to call a precious metal dealer. And here is the only precious metal dealer that I, the Biz Doc, currently trust, American Hartford Gold. They'll show you how to protect your savings and retirement accounts by diversifying your portfolio from stocks, mutual funds, and other things with physical gold and silver. With the finest products, fantastic customer service, and a buyback commitment, American Hartford Gold has earned a 5-star rating from thousands of reviews and an A+ from the Better Business Bureau. Tell them the Biz Doc sent you, and they'll give you up to $5,000 of free silver on your first order. Click the link in the description below or call 866-535-0767. Again, on your screen, 866-535-0767, or just text BIZ, B-I-Z, to 65532. So let's roll right into it. New business applications. So the department, let's pull this one up, Kellyanne. So basically, you look at cumulative monthly business applications in a given year, and you're looking at charts. It starts here at 0, and you keep adding them up till you get to the end of the year, and you're at some total number. That's why all the lines are heading up and to the right, which is what I like to say about charts. Don't show me a chart unless it's going up and to the right. What we have here is that cumulative new monthly business applications. And by the way, these are businesses that have the prospect of hiring employees. So they are not counting a business application that maybe, here's a great example. You live in Brooklyn. You open a dog walking and dog shampooing business, grooming. And it's just you. And maybe your daughter assists you or something. And you have a business license to do that. You get a little bit of insurance because you're dealing with people's dogs. That's just a sole proprietorship that's going to stay a sole proprietorship. This is not what they're counting. They were counting here businesses that have the ability and the likelihood of hiring 2, 3, or more W-2 employees that are not just going to be paid part-time, full-time. So this is like you open a dry cleaner with a business license, and you're going to have 2 people that are in the back cleaning, 1 person up at the front, and they're 40-hour-a-week people. That's what this is looking at. And what it's showing is here in 2023, things are growing almost as much as they did in 2021. Remember, 2021 was a pretty good economic year, pre-COVID, and you take a look at where 2013, 2019 is. So what's happening here? Why do we see business applications going up right now? Well, what you have to remember is they're counting applications a little bit over the shoulder. In 2023, you're growing business applications at a time where people have the perception that the economy is doing great. Well, the stock market is certainly doing great, right? You've got, the Nasdaq 100 tech, and the S&P is being driven by like the Magnificent Seven, NVIDIA, Apple, Facebook, Meta, you know the list. So those are really driving it. And so people say, well, the stock market's up, the economy might be up. Well, not so fast. You also have a softening of job creation. We had layoffs going on. Remember all the tech layoffs, fourth quarter last year?
Over 500.
Ton of them. So guess what's happening? You know what's happening, Kellyanne? What do you think?
Do you think it's because of the bumpy economy? That's why so many businesses are trying to start?
That is right. You get the Starbucks card. The bumpy economy. The economy is not as strong for the average Joe and Jane on Main Street as the headlines are for what's happening with the stock market and things around that. And the government has keep talking about job creation, but as the example I've used before, a lot of that is job back to work recreation, where you had people that worked at theme parks and things all through 2022 coming back to work as everything opened up again. So that's what's going on here. But it is important to note that guess what? People have the spirit of entrepreneurship going out to build businesses that are going to have more than just a sole proprietorship and a dog walking business. So I think that's a good sign for the future. There still is a 20 to 50%, depending on the type of business, whether it's completely unique, like you're opening a dry cleaner, the risk of those failing, as long as you're in a reasonable part of town, usually about 20% the first year. You're completely inventing something new, as high as 80, 90% the first year. So there's a scale that's in there. Nonetheless, I think this is a sign that entrepreneurship and personal, stick-to-itiveness and opportunist, in the American economy right here. People are just trying to build something rather than wait to be a victim of the other side of the economy. Speaking of the other side of the economy, of people that are working for other people in large numbers, check this out. Pop this up here about the, you know what this is? This is a chart from 1972 to 2022. 50 years. 50 years, right? And this is union membership in the private sector, going from 1 in 4 to 1 in 11.
Wow.
Actually, a little less than that. So it's 1/3 the membership. Actually, 1/4 the membership.
Yeah.
24% to 6%. This is union membership, people that are in unions. And you might say, hang on, Biz Doc, it's because unions are being broken, things are happening. Well, yeah, some of that may be happening, but it's also that union jobs that used to be union jobs are leaving the United States. This goes back to manufacturing. And this goes back to everybody that likes to say that the previous president in the United States who kept trying to bring jobs back, Harley-Davidson jobs, Westinghouse and Maytag, remember all those companies he was talking to that as soon as I'm, inaugurated, I want those jobs coming back from Mexico, back from other places, and have the American jobs here and find a way to make it work. Well, guess what? Some of those jobs would have come back as union jobs because some of those factory workers and things were in areas where there was already union presence. So be careful of how you criticize presidents on this. The fact is, union membership is way down, and this week, one of the most significant sector strikes in American business history went down. What is a sector strike? That means when a whole sector is hit, regardless of the companies in it. For instance, in the auto sector, automobiles, transportation, you have General Motors, Ford, and Stellantis. Well, remember, Stellantis is the old Chrysler. That's an old Fiat and Chrysler and all things together. So you'll see that word, and people have been asking me, who are those guys? And I said, man, pay attention, that's Chrysler. So when you used to say Ford, GM, and Chrysler, it's Ford, GM, Stellantis. So they're all being hit at the same time. And last night, I think Stellantis came out and offered 21% wage increase, and the unions are asking for a 40% immediate wage increase. Now, the unions know they're not going to get that, but they're probably aiming for 25%. Well, you got to be careful. On one hand, the unions have a small point, and maybe they should be negotiating rather than striking, where the auto industry got a bailout, the traditional auto industry. I'm not talking about EVs. The traditional auto industry got a bailout not too long ago. And, I think it was Ford didn't take any of the money going back to 2008 and TARP. And there were sequential points where the American people, the taxpayer, driven by administrations who were giving out support, like the Obama administration, giving out industry support, free money or taxpayer money from Washington, going out to do that. And so now they're saying, hey, the cars were making very strong profits the last couple of years. Is it time for them to adjust the union contract? Well, maybe the answer to that is yes, in a sane discussion, but they went straight for the throat. And they're like, nope. They didn't like the body language, and they didn't like the preliminary discussions they're having. Autos goes out. So what does this tell you? You're saying, Tom, I'm not going to operate a car company with 50,000 workers. What's going on? No. Here, when you're moving through stages from startup to mid-stage to going concern to more mature mid-stage to now established company, 5 years old, profitable, scaling and growing. Okay, at that point you look back and you may have an opportunity to adjust base salaries because now you can afford it. Maybe people came to work for you for a few stock options and then a salary that you could afford because they're thinking, well, I'm going to trade a little of my salary for some stock options moving forward. Happens all the time, Silicon Valley. And now you reach a milestone. And it's always better to proactively go and say, hey, folks, we're now able to fund an annual bonus. And the annual bonus is going to work like this. And I'm now going to be able to, hey, whenever there's payday, I'm buying lunch. We're going to bring in lunch, good lunch, from local restaurants, barbecue, Italian restaurants. We're not just going to bring in, pizza and 24 packs of soda. No, I'm really going to bring in some good stuff so that we can have, you get paid, you get fed. Free lunch on payday, or whatever the case may be. There's an opportunity for you to start doing that so people can say, you know what, as the business became more successful and got past this, I still have those stock options in exchange for the bet I took way over here when the company was just a baby. And now I've got a more normal salary, a more normal bonus, and I have a few benefits. It is always good as a business owner, and this is a lesson here, get ahead of that. When you see your success coming, time to go back, make sure you take care of your A players, your stars, and move forward. The auto industry, you know what? We don't know what went on behind closed doors, but some of the stories coming from a little bit more balanced news outlets that I've seen seem to suggest that the auto manufacturers didn't handle the conversations particularly well, and the unions, got upset, went out on strike. Now, maybe the unions were waiting for them to say, hey, what's going on? Let's talk today. Ah, wait, you didn't say good morning. You're just jumping right into it. We're not going to work with you. We're on strike. Maybe the unions were waiting for that, if you know what I'm saying. Just waiting for any excuse to say, all right, we're on strike. 'Cause they still had a warehouse full of picket signs and their plans were all there. So there's that possibility as well, that they always intended to go on strike from end to end against the big three. So maybe that was going on. And maybe the car manufacturers said, you know what, these guys are going on strike no matter what. So, you know what, doesn't matter what we say. We could be the nicest people in the world and the UAW is going on strike. Maybe that was going on. But the fact is now they're on strike and they got to figure out a way to settle this. And meanwhile, the Hollywood strike still hasn't been finished. And those poor people are on worse than lockout. Remember when we were on lockdown? I just said lockout.
What?
So all these workers in the unions that are making movies, television shows, content like that through the big media companies, the strike is still on. Nothing's been settled. They've had, maybe had close calls and everything, but there's a lot of things going on there. And so you got to take care of your people in advance of them going out on strike. But if they go out on strike anyway, you can't help it. And the message for you and me is take care of them before they say, you know what, I got a job somewhere else. I'm going to make $5 more an hour or something. Take care of your stars. I think that's the lesson here. Getting past all the politics of big unions and giant corporations and giant sectors. Now then, speaking of giant, Kellyanne, go to this one. This is very interesting. So, Facebook user growth is shown across the bottom from 0 to 5% a year. And then Facebook ARPU, and I'm going to teach you something, average revenue per user. So this is how cable companies think. This is how subscription OTT companies like Hulu think. This is how the mobile phone industry, long ago called the cell phone industry, that's how they think. What is my average revenue per user? In cell phones, it used to be $50. I'm paying $75 a month, my little sister's paying $35 a month, and it averages out for $50. They would say that's the average revenue we get per user. So this is Facebook looking at the average revenue per user, and most of this is ad support. So take a look at this. The US and Canada are growing 2.5% to 3% a year, $17.84 for 270 million users. Whereas if you go down to APAC, it's called Asia Pacific, 1.3 billion users and $1.63. So when you look at the Meta stock and you look at the value of Facebook, take a look at this. They can talk about, oh, we have 1 billion users in the rest of the world and 1.3 billion Asia Pacific, and we got 409 million in Europe and only 270 in the US and Canada. Yeah, wait, ho, 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 ho. Look where the money's being made. And by the way, Facebook is on the verge of going to subscription in Europe, because Europe has got some rules that are getting tougher about collecting data. Kellyanne, have you ever mentioned something maybe in a Facebook post with a friend, and all of a sudden tomorrow afternoon you get these creepy ads for exactly that?
It's not even on Facebook. I'll Google search something, and then all of a sudden it's on my Facebook ads, and it just keeps appearing. And now it's on Instagram because Facebook bought Instagram. So now the ad is just following me everywhere, just because one time I searched for a hair product or something.
You said something to somebody. You said, hey, you know, the picture at your sister's birthday, did you know you were still wearing the AirPod in one ear?
Yeah.
And then the next day you've got all these competitors to AirPods showing up. Yep.
It's crazy.
Well, guess what? Europe does not want Facebook to be collecting data as easily as they do in the US, and they're talking about making it less creepy and collecting less data. So Facebook is talking about, you know, moving to subscriptions, where maybe you just pay for ad-free. You know, the way you do Hulu, you know, and the way a lot of things are out there for ad-free. But anyway, that's the future of that side of it. But isn't it interesting? You look at that chart, and the United States is the big one. So why do you think Facebook spends so much on lobbying in the United States? Why do they over-prep Mark Zuckerberg when it's time to go get in front of Congress? Simple. The big blue dot at the top that says that their ARPU in the United States is $17.84, which is 10 times what it is in Asia Pacific and the rest of the world, where they have billions of users rather than a little bit more than 250 million of users here in the US and Canada. I think that's pretty interesting stuff. So when you put it in there, you know, as I always like to say, life will make sense when you find out what the data is and what that person thought the data was saying. Then things that you see in business and everything make perfect sense. You know, like the automakers thought that the workers are going to go on strike anyway. So what's the use to this? Just let's see if we can negotiate a little bit, and then they're going on strike, and there's nothing we can do about it. Anyway. So we move from that to Facebook, which is a public company. So we move from, today there was a nice progression, wasn't there?
Yeah.
Going from business licenses to the union, to a fully established public company. Now we're going to talk about a company that just goes on the stock market, ARM, designer of chips, and Instacart. I have a little update. I did the Instacart case study a couple weeks ago, but I have an update because tonight, Instacart prices the IPO. So when you're watching this, it'll be out on the market and we'll have seen the spike or whatever that I'm talking about. And if you're watching this a year from now, this is a case study of how IPOs typically operate. If you're lucky enough to be part of a company going public, or maybe you're going to build one that goes public in the future, or you want to know, should I invest in one on the day it goes out? All those things I think I'm going to help answer in a second. But right now, I'm going to go over to Studio B and find my board and get to it. Okay, boy, so a good thing that hallway's not long. Anyway, so today we're going to talk about IPOs. And specifically, there's some takeaways here, whether you're investing in an IPO, you're curious about what's going on with the IPO scene, or you're going to be part of a company that goes through an IPO. Maybe you're lucky enough to do that. I've done that twice in my career. It was a very exciting time. And today, there's two examples that we can talk about. One that just went public last week. You'll be able to search and find a bunch of things on it if you want to dive in even deeper. And one of them is going public, getting priced tonight, and will be going public between the time that I walk off and we put this one up live, and you'll be able to see how that went. Now, here we go. The first one is ARM. They design chips, and they make licensing and royalties off doing that. They're out on the Nasdaq, ARM. Then Instacart. I have a quick update on Instacart. We talked about them about 2 weeks ago. We did a case study all about them. I'm not going to go through that again, but I'm going to tell you what we just found out about their IPO that's going out this week. So first, let's take a look. IPOs are hot again. Here we are in September of this month, and take a look. We had a few in May, and this represents the billions that are raised excluding SPACs. SPAC is a poor man's way to go out public. A lot of companies do that. What I'm talking about, traditional IPOs that go out on the market and result in big money being raised for banks and big money going to the companies that go public on that day. So you can see September, we've even got a couple weeks left here in September, and this is really driven by ARM, and what's coming up is not even calculated in there, Instacart. Now, why are they hot? Well, debt is expensive, and that's just one of the reasons. You can only go public once, usually. You go public, and you can have secondary offerings and things, but you normally go public to raise money for your company. Now, on the flip side, when money is inexpensive, you can raise debt. Tens of millions of dollars in debt. If you're a profitable company and you don't want to go public just yet, you don't want the scrutiny, the quarterly reports, dealing with the analysts, all that kind of stuff, then maybe you back off and you say, you know what, here's what I'm going to do. I'm going to raise some debt. Now, debt, as we look over here, this is LIBOR. LIBOR stands for the London Interbank Overnight Rate, and LIBOR, for 50 years, was how you would measure interest rates, most of the time for companies that had, as we would say, paper with a bank, where they would say, your interest rate is LIBOR plus 1. So you would look in the Wall Street Journal, find out what LIBOR was, say 4%, plus 1 is 5%, that's your interest rate. Well, at the end of June of this year, they stopped using LIBOR, and now it's going to be SOFR, which is basically Standard Overnight Funds Rate, and there's a couple other abbreviations and a way to look at it, but it all literally makes the same thing. What is the overnight rate that the best credit worthy businesses would receive? And as you can see, from 2021, do you see what the Fed did? Look at this. Look at that. You have to go all the way back here to see that same thing. Even in 2008, when things shot up, it was less than that. You have to go back to 2007. We're talking 16 years ago to see the up like this. So that means if you're a business right now and you're going to go out and get a loan, a pretty good loan, let's say you're a pretty good business, and they tell you it'll be at SOFR plus 2, that means here's 5.5 plus 2 is 7.5. That means for every $10 million you borrow, you have 7.5% to pay. That's almost $750,000. Suddenly, that's a lot of interest. So if you're a private company, maybe looking for $100 million to expand a factory or buy a small competitor, you would say to yourself, wow, that's going to cost me $7.5 million a year. So that's $28 to $30 million for over a 4-year period, assuming interest rates stay in this zone, and you are on a floating rate, which is the old LIBOR plus something, and now SOFR plus something. So you look at it like this, and you say, maybe we just go public. If you're strong enough and you're positioned enough to go public, you do it. Otherwise, you may take big debt and maybe pay off some of your early investors at an agreeable thing. Well, this is just one of the reasons, but I wanted to kind of show you the history of debt over 16 years, how it's never been more expensive to borrow money as a company over the last 16, 17 years. So now, let's talk a little bit about ARM. ARM is very unique, wonderful tech leader. SoftBank actually owns ARM. Well, they did until Friday. Now it's public market, and the people, the shareholders, own ARM. They bought ARM back in 2016. ARM designs chips for almost everybody, believe it or not. Apple, AMD, Qualcomm, NVIDIA. ARM technology and designs are in all sorts of chips that are made by semiconductor designers. Qualcomm makes semiconductors and makes chipsets. The Snapdragon chip. NVIDIA, we know who they are, making gaming chips and AI chips and things. And meanwhile, ARM is sort of the designs that are behind so many of these. Then, ARM chips are in 99% of smartphones. 99%. I don't know why they don't just say all smartphones. I guess there's a couple models out there that don't have it. But it's basically in all smartphones. And by the way, Apple in the United States is a huge percent of smartphones, so no surprise. Then ARM gets its money 2 ways. 63% of its ARM revenue comes from royalties. Royalties, ARM gets a payment on chips sold. So maybe that's an ARM chip. There used to be chips way back in the day when we were designing early chips called ARM 9s. We're 20 years downstream from those, but there are actually ARM chips that are in there. So if you use one of their chips, they get a payment for every chip sold. Or maybe 37% of revenue from licensing. Licensing, if you're a customer and you made your chips with some of the ARM portfolio designs or their intellectual property, you agree to pay 37%, you agree to pay licensing, and the licensing is 37% of its revenue. So you see, ARM is very, very profitable, very strong company, and they're everywhere. So there's a lot of growth potential here. So ARM goes out, the IPO. How did the first day play out? Well, they put out 95 million shares, and at 51 was about $55 billion valuation. And by the way, that resulted in $6 billion going to SoftBank, but SoftBank only put 10% of the company on the stock market. So if you bought all the shares on the stock market today of ARM, in other words, you took $54 billion, it would be $5.4 billion. It's only about 10% of the company that's out there on the market right now. Then, interesting, Apple and NVIDIA bought shares in the listing. This is called support. So sometimes if you're a little nervous about going out public, you will have some of your customers line up, or key suppliers line up and buy allocations during the IPO, and you tell everybody, by the way, get in on this IPO. I got Apple and NVIDIA buying shares from me. They're going to own corporately. So that's a way to help the IPO get off to a good start from showing key support from key players. So they traded at 55 out of the gate. So wait a minute. Why is it trading at 55 out of the gate when you said 51? 51 per share is what everyone paid ARM the day before it went public. And then when it goes public, the first trade on the market is immediately affected by the market forces of supply and demand for that stock. So the first trade was $55, which means these people were 10% up on the first trade. Then the IPO spike. What's the spike? Well, most IPOs are priced slightly more conservative than market. And sometimes the investment banks intentionally price them very conservative to market so that when it comes out on day one, there's a big pop. And some of those people that owned it at, say, 51, when there's the big pop, they drop them because the 25% spike in this case was almost $69. So if you're in at 51 and you sold on the day of the market, if you were allowed to, because sometimes you're in lockup periods that you can't sell for a while, but if you're permitted to do that on those that goes out, you're holding 51, goes out to 67, you sell it that day, you just made 25% on your money. Not bad for a day's work. And at the end of day two, there was an $85 billion market cap. So this is kind of how it works. You go out on a road show, you're selling it at 51, Apple and NVIDIA say we're in, this is a good thing, we like it, and then the bankers are saying, if Apple and NVIDIA like it, why don't you like it? And away you go. Well, here's what the IPO looked like over those days. Here's that first big jump on day one, and then you can see you get up to a spike here, and then you settle out at $60.75 at the day two. So there you go. See, 51 was your IPO price, 55.54 first trade, 63.59 first day close, quick peak. There's usually a peak in there at 69, and finally 67.5 second day close. Now, I have sitting here, not far from me, Kellyanne. We can't go to you, but can you look up and tell me what ARM is trading in now? ARM stock price. Anyway, she's going to go look that up because now we're sitting here getting toward the end of day three. And so you'll see where it goes, how the spike comes up, comes down. And so it's going to be down 58, 56, I'd be willing to bet, very close to the offering price. So I've kind of stunned her a little bit here. ARM stock price. Anyway, so note to editor, just pause it, pause it, pause it.
Because I can't use the computer because it's on there, so 1 second. ARM stock price.
ARM stock price.
55.43.
Yep.
What is it?
55.43.
Anyway, so look, fortunately, editing note, roll back about a minute. Anyway, with all that, fortunately, Kellyanne is sitting not far from here. And Kellyanne, what is the stock price right now? Because right now we're at the end, almost to the end of day 3 of trading.
It's 55.43.
So 55.43. So guess what? It's almost right back where it was for the first market trade, which means the first 2 days, you pop out some gap to your actual sale price that you sold to everybody before it was on the market. You have some sort of a spike, and then you have a settling as anybody sells out. You know, this is here retail demand. Retail is you and me that didn't get to buy at 51 before the minute before the IPO. We bought on the market. Look at that spike right there. That's the volume. And then everybody just sells off a little bit in there to where we are today. 55.43. We're right back where we were at the end of day 1. And ladies and gentlemen, that is usually how an IPO plays out. So you can see there's a little bit of rigging in here that ends up favoring the insiders, and the retail investors usually are better off waiting for this to settle and to see where it goes from there. But anyway, that's ARM, and that's how the IPO played out. Thank you very much, Kellyanne. Now, we're going to go. How's it going with Instacart? Now you understand a little bit about how IPOs work. Let's look at Instacart. Update. So they're going to price it tonight. So that $51 that was for ARM, boom, they're going to name whatever their number is, and that's the number that everyone is paying tonight. They pay it a minute before the market opens. When the market opens, there'll be some sort of settling effect, which, as you saw, was a little over $55 for ARM. Instacart, what are they saying? 22 million shares will be sold, and our range is now 28 to 30. Previously, we thought it'd be 26 to 28, but they think that the market, with debt being expensive, is really into IPOs right now, and so they've raised their range $2 and to a $10 billion implied valuation. By the way, if you really want to have something valuable, build a chip company. It was $55 billion, right? Huge. Now, at $30, top end of range, you know, the IPO will yield 660 million versus 616. So check that out. That's almost 10% more that they're receiving. And why are they doing it? That is the money that goes to the company. But where is it going? Aha, 237, give or take, could go. Now, the reason I say could is because there's usually rules and a lot of agreements that are made in here based on the actual price, the actual sale, was it oversubscribed, a lot of things that go together in there that triggers whether the investors or insiders looking to sell their shares can actually sell. Now, before you get all excited and say, really, insiders and previous investors are going to be able to pocket $237 million, just remember, they raised $2.9 billion over time. So there's a lot of people in there that are going to want their shares to be far more valuable than this, and they hope that Instacart is going up to a bright future. And remember where I said that Apple and NVIDIA were buying ARM shares ahead of the IPO and making sure everybody knew it, because the bankers are out there saying, if Apple and NVIDIA like it, why don't you like it? Right? Well, guess what? It was Pepsi over here that bought a ton into this IPO. And lastly, let's all keep in mind on Instacart before we get too excited, the IPO of $10 billion is 1/4 of the $39 billion valuation after the last funding round 2 years ago. So they've got some growing to do to get back to the point where all of their investors can be made fully whole and then some. And that is the update from Instacart. It's going out this week. By the time you're watching this, you'll be able to go back and look at the 3-day chart that we just looked at for ARM, and to see what was the gap, what was the offering price, what was the gap to first trade, what was the spike over the first 2 to 3 days, and then whereabouts did it settle. It's always interesting to me to go take a look at that, and now you know how to look at it. Anyhow, that is what is going on with IPOs this week, and there's a lesson in it from ARM and Instacart, lesson for us that we can apply. Whether you're watching it this week in September of 2023, or you're watching it a year from now, and you're basically now looking at a historical case study of IPOs when the market started kicking up a little bit in September. That's what I got for you this week. I hope that was helpful. Now, I'm going to go back to the main studio and wrap it up. All right. I hope that was helpful. I love these case studies, and what just is going on with the IPO scene, that's pretty big. If you like this case study, you may check out this one or this one from the Biz Doc archive. Very interesting stuff there. And if you want to ask the Biz Doc or Patrick or Vinny or Adam or any of the talent here at Valuetainment, download Minect from iOS or Android to your phone. You'll find us on there along with other experts, and you can ask a question. We'll send you an answer in text or a quick video, or you could even set up a one-on-one video conference with us. Minect from Valuetainment. Until next time, I'm Tom Ellsworth with the Biz Doc, and I hope I left you better than I found you.